I am Dr. S.V. Revati, Assistant Professor, Department of Commerce, PPG College of Arts and Science, Coimbatore. Introduction of Income Tax. The Direct Taxes Administration Inquiry Committee, under the chairmanship of Mahavir Tyagi, submitted its report on 30th November 1959, and its recommendations took shape in the Income Tax Act 1961. The Act, which became effective on 1st April 1962, replaced the Indian Income Tax Act 1922. The man who introduced income tax in India is James Wilson. The Income Tax Act 1961 is the set of rules and regulations upon which the Income Tax Department lives, administers, collects, and recovers taxes. It contains 298 sections, 23 chapters, and several important provisions which contain all the aspects of taxation in India. In simple words, the tax is a part of our income paid to the government. So, the tax is compulsory enforced contribution to the hard-earned money to the government to pay taxes. Thus, a tax is a mandatory fee or financial charge levied by any government on an individual or an organization to collect revenue for public work, providing the best facilities and infrastructure. The collected fund is then used to fund different public expenditure programs. Government may levy taxes on income, business profits, or wealth, or add it to the cost of some goods, services, and transactions. Benefits of tax. With the help of the tax paid by the taxpayers to the government can fund infrastructure projects like construction of roads and bridges, building of schools, hospitals, renovation of dams, libraries, providing water supplies, generating electricity, etc. Thus, government launches new welfare schemes for the benefit of the people. Types of tax. The taxpayer must pay direct tax at a certain percentage based on his or her income, while the indirect tax is levied by the government during the sale of goods and services. Tax are divided into two types. They are direct tax and indirect tax. What is direct tax? Direct tax is paid by an individual on the personal assets and income, and it is paid to the government. Direct tax are further classified into income tax. Income tax is a tax paid by an individual. It is paid when total income exceeds taxable limits and its prevailing rate is applicable from time to time. Capital gain. It is a tax on gain of capital. If you sell property, bonds, shares, etc., and if you earn income from that, you are supposed to pay this type of tax. Securities transaction tax. It is applicable on every transaction done at stock exchange. If you buy or sell shares on derivative instruments, it is applicable. It is normally paid along with transaction itself. Perquisite tax. It is a tax benefit given by the employer to an employee. Example, non-monetary benefits like car with driver. Corporate tax. These are annual taxes payable on the income of a corporate operating in India. For the purpose of taxation, companies in India are broadly classified into domestic and foreign companies. Indirect taxes. The indirect tax are those tax which are paid by the taxpayers indirectly. When purchasing some goods or commodity, this type of tax is applicable. When hiring some services, we are taxable. The indirect tax are further classified into excise duty charged on goods manufactured in India, custom duty charged on import and export of goods into the country, goods and service tax charged on supply of goods and services, securities transaction tax charged on stock sold on purchase through Indian Stock Exchange, stamp duty charged on the transfer of immovable property, value added tax charged on sale of movable goods. Direct tax versus indirect tax. The direct tax is paid by an individual to the government directly. These types of tax are non-transferable and hence the taxpayer has to pay tax directly to the government. These taxes are administered and governed by the Central Board of Direct Taxes. Examples of direct taxes are corporate tax and capital gains. The ultimate burden of the tax is paid by the organization or an individual and he or she has the responsibility to pay taxes. Example, when you earn income, you are responsible for tax payment and you also have the burden to pay taxes. Indirect tax. The indirect taxes are transferable and where the liability to pay tax can be shifted to others, and these taxes are administered and governed by the Central Board of the Indirect Taxes. Examples, service tax and sales tax. The ultimate burden of the tax payment is made by the purchaser and he is the responsibility to pay tax. That is, the shopkeeper has the responsibility to pay taxes. Example, when you buy things, the shopkeeper is responsible for tax payment, but he can collect it from you. As a taxpayer, any kind of income tax falls under five major categories. The first one is income from salary. It falls under section 15 to 17. The second one is income from house property. It falls under section 22 to 27. The third one is profits and gains of business or profession. It falls under section 28 to 24. And fourth one is income from capital gains. It falls under section 45 to 55. And the fifth one is income from other sources. It falls under section 56 to 59. Income taxable under 5 heads can be calculated as salary is calculated working for someone on salary basis and it includes both monetary payment and non-monetary facilities. Computation of income from house property. If you are having a house from which you get a rental income, it may be residential building, flat, shop, etc. In these categories, income from house property is calculated. Income from profits and gains of business and profession is calculated by having a profit or loss from business or profession. Business means any trade, commerce, and manufacturer of goods and services, whereas profession means requiring special knowledge and skill to be applied for individuals for their occupation. The computation of capital gains is calculated owning long-term assets like shares, bonds, mutual funds, property, etc. It includes both long-term and short-term capital gains. Income from other sources, it is calculated on the dividend income, interest income, and then family pension or any other sources of income such as winning from horse races, gifts, lotteries, etc. Basis of income tax. According to Section 4 of the Income Tax Act of 1961, income tax is charged in assessment year at rates specified by the Finance Act applicable on 1st April of the relevant assessment year. It is charged on the total income of every person for the previous year. Total income is computed in accordance with the provisions of the Act. Income tax is to be deducted at source or paid in advance wherever required under the provision of the Act. According to the Act of 1961, Section 2, Subsection 34 of the Income Tax, the term previous year commences for the period of 12 months from 1st April to 31st March. For example, the current previous year falls from 1st April 2022 to 31/3/2023. According to the Act of 1961, Section 2, Subsection 9, the assessment year commences for the period of 12 months from the 1st April to 31st March. Example, the assessment year falls 1/4/2023 to 31/3/2024. The income earned during the previous year is taxable in the current assessment year and it will be taxable in the assessment year. Thank you.